Yo, what is going on? It is Maleki, the growth and dividend growth investor. Welcome back to the channel. I have my wonderful monthly portfolio updates. I'm very excited for you guys deciding to watch this video. So let's get to it. In my portfolio, I have $263,807.59. If you look to the bottom left over here, you can see that my portfolio has been growing quite nicely. Predominantly, a lot of this gain is from my growth holdings, which has been making up 61% of my portfolio. But with that being said, these other ones are still doing exactly what they need to be doing. Let's talk about our 401k. So in the 401k, even though it only makes up about 20% of my portfolio, I believe my 401k and my Roth IRA dividend investing is the backbone of my portfolio. So these two make up about 27% of my portfolio, but I believe this is the backbone of my portfolio that allows me to make higher returns in these other sectors. Your 401k is like that index investing strategy, which has produced quite a lot of millionaires. And, for the most part, you want to make sure that you are investing in a 401k, regardless if you don't believe investing in bonds or whatever it is. This has made the most millionaires out of any investment style or type. So, you definitely want to make sure like you can have this. If I didn't have a 401k or a Roth IRA, I would not be aggressively putting my holdings into I wouldn't put as much money as time and dedication into growth holdings because I have these, it allows me to be a little more aggressive with some of these other things that I'm working on, which I'm working on quite a few things, just to expand my horizon when it comes to investing. My Roth IRA, so 401k, $53,611. Again, this definitely has been the backbone of my portfolio. It's been going very nicely up ever since the crash in March. It's been doing what it needs to do. Like there's ups and downs, but it's continually going up, and that's exactly what a 401k or like an index investing portfolio will do. Like it kind of goes with the market, but again, over time, it will keep going up. For my Roth IRA, I did make a couple different switches around in my portfolio. So total amount I've invested is $17,647.99. What my plan is I'm trying to max out, get the full $6,000 over here, which, I'm still about like $4,040 away. But my number one priority is to get this Roth IRA maxed out so then I can put my money towards the growth holdings. I used to be investing $500 a month here, but I just want to max out the Roth IRA. And then once this is paid, I want to switch over to the growth holdings. So I haven't been adding any money into these growth holdings, but I have technically been adding money to these growth holdings because I am using a covered call strategy, which we'll talk about in a second. So my focus was to put money here, use covered call strategy to put in money here, but let's just kind of keep going over my dividend growth portfolio. I'm pretty excited about, my new covered call strategy that I'm working on. But at the end of the day, I just still love the idea of dividend investing. I think dividend investing is a very powerful tool. I believe just the idea of getting paid money from these companies for just holding on to them is amazing. Like I love that companies are rewarding shareholders for investing in their company by giving them dividends. So in my portfolio, in the past, I used to have another 10% pie right here that strictly focused on income. It was called QYLD. What I ended up doing is I ended up deciding to sell it. So over here, I sold QYLD, and the proceeds of the sale of this went to all of these different stocks over here. And what my thought process was is, yes, I like the income aspect of this. I was getting about a 10% yield per year, but there's an expense ratio of 0.6. Now, since I got rid of it, I don't have any expense ratio here, and I'm just investing in just dividend stocks. So just kind of going over like my gains and losses and things like that. I'm just going to go to my holdings tab and look at the biggest winners and losers. So from a percentage standpoint, Apple, Disney, JP Morgan, Qualcomm, these are all things that are doing well in this market. And then the things that are not doing too well is Merck, Crown Castle, Honeywell, Procter Gamble, American Tower. These are all really good companies. It happens to be that the market is voting right now, and they're saying that they don't want to own these companies. But in the long term, the market's just a weighing machine. So, yeah, it's down right now, but I don't necessarily care because I'll be getting paid a dividend. And then when I keep putting more money in, it'll keep cost averaging these down, which will ultimately grow over time. So if you look at this dividend portfolio, again, just like pretty much everyone's portfolio was in March, it was down. But again, just a nice steady increase. I put the $6,000 in there. The dividend income is allowing to capture these little ups and downs, and ultimately it is going up. So again, that is the main goal of dividend investing, is just to kind of build that wealth over time. And then when you retire, you just live off the dividend income. You don't touch that principal. So I still love that idea. So that's my dividend portfolio. A couple changes there. I may add some holdings into my dividend portfolio, but if you guys were curious on what I am holding in these accounts, I do share my pie. So if you guys want to take a look at what I do own, definitely just take a look through there. It'll be like I'll link the description, and I'll link it in the description down there. Now, the next thing we're going to talk about is our growth holdings. So in my Fidelity account, I used to have a brokerage account through M1 Finance for my brokerage, but M1 Finance did not offer any, they didn't offer any like covered calls or anything like that. So what I wanted to do is I wanted to have the majority of my money in a reputable company, and apparently Fidelity is one of the top companies to put your money in. So currently right now I technically only own 200 shares, but I bought 100 shares of Tesla on margin. So the 200 shares I do own, they've been doing very well for me. I've been getting a pretty good return. My portfolio value is this. Today's been like fluctuating. I think Tesla's been on a down day. When Tesla's down, like they're down like always like 5 or 6%. So I'm not too concerned about Tesla being down, because the overall plan is to keep adding to my position and building it over time. If you see here, these are my 2 covered calls. I put covered calls every single week. I don't do monthly. I don't do 30 days out. I don't do 45 days out, because I don't like the idea of my shares being locked away for that long. I like to every week kind of run through a couple scenarios in my head, like, will the share price hit this price by the end of this week? And so it gives me a little bit more control deciding when I can get rid of them. But the goal here is I don't ever actually want to get rid of these 200 shares that I own. Like the ones that I built over time, like I am not getting rid of them. I'm still focusing on that long-term investing. The goal is still long-term investing, but what I want to do is I want to get paid to long-term invest. So in my head, I decided that like Tesla's never going over 950, but to be extra safe, if it did blow up and went to like $1,100, I don't think it would go past $1,100. So yeah, the premium is not that good. I got probably 54 bucks per contract, so I got like $108 just for holding Tesla, which is something I'm already doing. So like I already got $108 for doing something I already did. So then again, it gets added to the pile, and then I could keep acquiring more shares of Tesla. This Tesla right here, this 100 shares, well, I'm using that on margin. So the point of using the margin for this is to sell at the money calls. And again, I'm already holding Tesla. I'm a long-term investor. So if some of the covered calls do go south, it doesn't matter to me, because I don't mind holding on to these shares. And then I keep selling the exact same call that I want to get rid of it. So like, I did an 882 call. Well, the share price is a little bit lower than that, and that's totally fine. I'll maybe get less premium, but I'm still gonna sell it at this. So, the week before I did like a call which I got $3,000 for. Then the following week was like 400 bucks, and now it's Tesla was bumping up, and then I got $1,860 for selling this call. And we'll see what next week does, but like I don't mind selling it at this thing. So like I bought for 880, I'm selling it at 882. So the point here is just to sell the calls at the money and just keep making income. If I have to hang on to it, not a big deal. But my goal is like to get like $1,000 a week for this, 1,000 to 2,000. Ideally 2,000. Higher than that would be the goal. But I think I've been reaching that goal pretty consistently, and I've been just aggressive on this for the last couple of weeks. So we'll see how it does go in the long run. But again, this is not for long-term investing. These are for long-term investing. This is just to produce income. All right, so it's just a different strategy, different tool to use. Let's go back to this. So then, we're going over our growth holdings, this strategy, 161,000, and then my option harvesting. So let's go over here to my Robinhood account. So I started this account with $16,000, and I have not used any of my own money to add to this account. So, I built it up to $31,000 since that same time in December. So like December 15th to 20th, like that's when I started. So I've almost doubled my money already. Um, and this account I do use margin as well, but I'm not maxing it out. So like for example, like this week I bought 600 shares of uh, Virgin Galactic. I realistically, with the 30,000, could have bought like 520, but I used margin to get me another 80 shares. And like I'm not trying to like max it out or anything like that. Like that's not the best strategy to use. So the following week, I my Neo shares did get assigned. So then I decided that I wanted to buy 600 shares of Virgin Galactic, and then I was going to sell covered calls on that. So I bought the Virgin Galactic shares for 55.70, and what I did is I sold 6 calls at 56. Okay, so each contract they were paying me $390 or $3.90 a share. So you multiply this by that, and I got paid $2,340 just for selling this contract. So yeah, I'll make a little gain if it does sell at 56, like 30 cents a share. But my goal is not price appreciation. My goal is just income. I care about price appreciation in my Fidelity account. I don't care about price appreciation here. My goal here is option harvesting. I just want to get paid for at the money calls. So basically, moving forward, kind of what the plan is for like next week. So let's do trade Virgin Galactic, sell, call, and then February 19th. So first thing, Monday morning, we're going to determine what the play is. So if by tomorrow Virgin Galactic closes under 56 bucks, I'm going to retain my 600 shares. If that is the case, I'll probably sell first thing Monday morning this 56.5 call. I'll get paid almost double than what I got paid this following week. I'm going to get a 550 call. So then just by selling the 6 contracts for 550 bucks, I'll get $3,000 for this. So this is what the play seems to be like for Monday. Now, for whatever reason, and this stock price keeps dropping and dropping and dropping, I don't necessarily mind because I'll keep bag holding it, but I'll keep selling this call over here, the 56 call, until it recovers, if not go higher. So that is the play. Okay. So that's kind of what I've been working on. Let's just talk about the covered call income. So as a registered nurse, I make about $6,194.88 a month. This is not taking away taxes, my 401k, anything like that. This is just like the raw what I make in a month. This is what I made in December, half of a month of December, and then this is what I got paid out in January. So predominantly, as doing these covered calls, calls have almost doubled what I make in income as a registered nurse. So it'll be really interesting to see how it does perform, kind of moving forward. Like maybe in the next couple of years, like if this keeps going the way it is, like I could retire from being a nurse, or I could essentially maybe switch to part-time so I don't have to work 312s, and then I could spend more time traveling. Again, this is a tool and gives you options. But we'll kind of see how this does moving forward. This is like, investing for someone who's like more of an active investor. Well, we'll look over my fiance's account where it's more passive and ETF focused. So we both have the exact same 401k, same strategy here. Just put some money. We're both putting money in over time with every single paycheck being taken out. And then in her Roth IRA, the focus here was income. So just like it was kind of like an interesting comparison that we're going to have, because my Roth IRA is more focused on individual dividend stocks, where hers is like high yield ETFs. So we're just going to see how the two kind of compare and contrast against each other. So it's kind of like a little science experiment. In terms of brokerage account, our focus here was more growth than dividend income, because it's better to have dividends in a Roth IRA because they don't get taxed and they can allow to grow much faster without any inhibitions or anything like that. Where a brokerage account, if you get dividends paid, like, it's nice to get those dividends, but at the end of the year, you're going to have to pay taxes on those, which kind of take away from your overall gain. So the goal here is more of a growth focus. So VTI's total U.S. market, total international, triple Q, and then ARC. So because I have these here, I don't necessarily have to put this into my growth holdings. I could be a little bit more riskier because my fiance is having safer options over here. And then just kind of looking over here, it is kind of for a newer investor, it could be pretty intimidating, or like not assuring, not like self-assuring, that like, you only have this much money and then there's people in the world who have like this much money. I'm here to say that we all had to start at some point, and actually years and years ago, this is exactly where I started. I just focused on ETF investing, and that's where initially I started. But then I came to the realization that a lot of these ETFs pick like the top 10 biggest companies in like each sector, and like that's kind of how I built my Roth IRA. But like you don't need to be an active investor to invest. Like you just need to do something. In this case, my fiance is not an active investor, but she's doing all the right things. She's picking these ETFs, and then it's going to grow over time. So, it could be intimidating looking at that bigger account, but like you will get there, and it's going to take some time, but like you will get there. So, it's going to be interesting to see how her account grows compared to mine. So maybe at the end of the year, we can do like a comparison between like from a percentage standpoint, whose has done better versus, each other's. So just kind of interesting thing. Just kind of going over her dividend income over here. I remember a lot of these times, a lot of these months, we didn't have this allocation. It was very similar to this, and then we switched over to more of a dividend allocation, which is why we get a huge payout here. So it's going to be interesting to see if we're going to capture this dividend income. So I want to see it grow compared to this account over here. So then switching over to my account, in January, 59.69. So, the end goal over here in like dividend investing in this Roth is to see like year over year increase. So in January 2021, I made this much. Last year I made that much. So ideally the goal is like each month the following year, I want to see it go up. The most important thing is that nice uptrend, which again looks like we are capturing that over time. And yeah, so that's a pretty nice thing to do. I will just have a side note here. I did switch having that QYLD, so these will probably look higher because like the QYLD was a huge chunk of that. So when this compares to this might be probably lower. That's just because I switched over to individual stocks, not that ETF. And then the final thing I just want to go over is my little covered call spreadsheet. Each different color is like a different month. So this is like half of December. This is all of January, and then this is my February covered call. So this is all the amount of income I'm making on these calls. And then overall, looking to the right over here, I made $20,960 selling covered calls. And then my total expense is $462.28, and that's the fees to do the options as well as whatever margin I'm using. So my total premium harvested after expenses is $20,497.72, which is a pretty good amount of money. So like that is a good amount of money. So then I kind of have some rules over here of what I want to do with these covered calls. So basically what the move is to use income to pay margin. So once I pay the margin off, ideally with the 100 shares of Tesla, I'm just going to keep doing the same thing. And then if it's a little bit more expensive, then just use the margin for that, but like not to use a whole amount of it. And the estimated payoff is 1 year. And then after that, if anything drops the maximum margin, I do want to ever use 25%. And then use premium to acquire shares. And then at the end of the day, this is the most important thing. Investments must pay for your lifestyle. So this is just my spreadsheet over here. So just discussing all these different things. So I appreciate you guys watching this video on this update. If you have any questions, let me know. Please drop a like, subscribe. Really appreciate it. And then yeah, you guys have a good day. Appreciate it.